In January 2026, the silver market experienced a massive, violent repricing. In less than 30 hours, an asset traditionally viewed as a stable store of value went vertical and then immediately fractured. Silver surged 65% in a single month to reach an all-time high of $121.62 per ounce. Then it suffered a vertical 40% collapse that wiped out an estimated $7.4 trillion in combined market capitalization across the precious metal sector. This chart maps out that exact January price action. You can see the steady climb from an opening price of $70, peaking late in the month, before entering that narrow 30-hour crash window down to the $75 mark. To see why this collapse was so violent, we have to look past the trading desks. This 30-hour crash was built on a severe 6-year structural deficit in the physical supply of the metal itself. Silver has outgrown its historical role in coins and jewelry. Because it possesses the highest electrical and thermal conductivity of any known metal, it is an irreplaceable component in modern infrastructure. This diagram shows the converging vectors of that inelastic demand. We see a heavy reliance from next-generation photovoltaic solar infrastructure, which converts sunlight directly into electricity using silver pastes, alongside critical applications in AI data centers, electric vehicles, and highly specialized defense systems. Looking closely at this bar chart of the 2024 industrial consumption data, two sectors dominate. Electronics required 310 million ounces of silver to build components like printed circuit boards, while solar panel manufacturing consumed 140 million ounces to keep pace with global energy mandates. But the U.S. produces under 1,000 metric tons of silver domestically each year, forcing the country to import nearly 70% of its total consumption. Compounding this risk, foreign nations control an estimated 70% of the world's refined silver supply capacity. This flowchart illustrates how the U.S. government mathematically quantified that threat in late 2025. By running a new economic effects assessment, they calculated that a single supply disruption from a major partner like Mexico would trigger a $435 million drop in the U.S. GDP. Based on this math, silver was officially elevated to the U.S. Geological Survey's critical minerals list. This physical reality, where surging demand from the tech and defense sectors collided with a stagnant mine supply, created a legitimate structural deficit. That deficit is what pushed the baseline price of silver past $70 an ounce. However, physical industrial consumption moves slowly. The relentless demand for solar panels and missiles did not drive the price from $70 to over $121 in a matter of weeks. Instead, a flood of retail investors and algorithmic trading funds piled into the paper futures market. They treated silver as a leveraged financial play, buying derivative contracts to bet on rising prices without ever taking physical delivery of the metal. This speculative frenzy created a massive imbalance. By late January, for every one single ounce of actual physical silver sitting in Western vaults, there were roughly 356 paper claims being traded on the exchanges. The market had decoupled from its physical industrial roots. It morphed into a leveraged financial balloon, stretched to its limit and waiting for a pin. The first shock arrived on January 30th. The White House announced the nomination of Kevin Warsh to lead the Federal Reserve. Warsh is recognized by capital markets as a strict inflation hawk. His appointment signaled an immediate end to easy monetary policy and higher sustained interest rates. This sparked a sharp rally in the U.S. dollar, which acts as direct kryptonite for non-yielding metals like silver. A surging greenback mechanically triggered high-frequency trading algorithms. Within milliseconds, these programs executed a cascade of stop-loss orders, injecting extreme volatility into the exchanges. Faced with wildly escalating price swings that threatened the clearinghouse, the CME Group, the exchange where these futures are traded, executed an administrative kill switch. The exchange abruptly hiked the maintenance margin requirements on silver futures to $25,000 per contract. A maintenance margin is the minimum amount of equity an investor must keep in their account to hold an open trade. This sudden increase meant anyone holding leverage positions had to instantly deposit massive amounts of cash. Those who couldn't were forced into immediate liquidation, creating a violent margin massacre that accelerated the sell-off into a vertical cliff. The 30-hour collapse from $121 was an acute liquidity event. It was a mechanical purge of over-leveraged speculative paper, not a failure of actual industrial demand. When the margin calls exhausted themselves, the market found a hard floor. Silver stabilized in the low 70s and refused to drop further. While paper traders were scrambling to cover their losses, industrial conglomerates and retail buyers across Asia treated the 40% paper crash as a rare discount. They aggressively entered the physical market to secure massive quantities of the actual metal. The panic of Western speculators liquidating digital derivatives contrasted with the physical accumulation in Eastern trading hubs, where manufacturers rushed to secure real inventory. Major financial institutions recognize this divergence. JP Morgan adjusted its 2026 average silver price forecast to $81 an ounce, more than double its previous year's average, acknowledging that physical scarcity had established a new baseline. For resource investors, the timeline reveals two distinct realities. The speculative froth was violently washed out of the system, but the 6-year structural deficit underpinning the global supply chain remains intact. Silver has shed its historical identity as a supplementary monetary hedge. It is now a strategically hoarded industrial asset, fueling the modern economy. And moving forward, extreme price volatility is simply the cost of admission.